In terms of the larger billion-dollar plus funds, they're missing hundreds of funds that we have that trust us with their data. And to your point, these aren't just random. These are funds that actually have almost double the performance of all other funds that they cover. They actually have over 4% more per annum in performance. Actually, almost 4.5% of that is in the form of alpha. 400 basis points can easily be the difference between a model arguing for a significant allocation to hedge funds in general or zero.
This episode is brought to you by VanEck Semiconductor ETFs. You'll hear more about the VanEck Semiconductor ETF SMH, the largest semiconductor ETF, and its newer VanEck Fabless Semiconductor ETF SMHX later in the show. Let's get into it. I am joined today by Jon Caplis, CEO and founder of PivotalPath, a hedge fund research provider serving institutional hedge fund LPs. Jon, thank you so much for joining me today.
Max, thank you for having me.
PivotalPath really sits at this intersection between data providers, consultants that are serving the institutional LP universe, which is pensions, endowments, I'm sure fund of funds, banks, and it's a space that has a lot of different people who do everything, I feel like, slightly differently. So, what would you say about PivotalPath sort of separates you from the other people in the hedge fund data and research space?
Yeah, so I'll give you kind of a high level overview of what we do and how our clients work with us. So I founded the business back in 2013, so coming up on our 12-year anniversary. Today, we work, just as you mentioned, with institutional LPs that collectively invest actively over $500 billion in hedge funds. And while they range from single family offices in Hong Kong and Singapore to state pension plans and private banks, all of the things that you mentioned, public pension plans, um, all of them are working with us for really three key reasons. And so these reasons, while they may have different approaches, as you mentioned, there's really three overlapping elements. And the first part is the completeness of our coverage. And it sounds relatively simple, but we cover over 3,000 hedge funds. That is the vast, vast majority of every institutional quality fund out there across the globe. It represents over $3 trillion in hedge fund capital. And so they know that when they're working with us, that the picture is going to be complete. They're not going to miss something because they just didn't know about it or it wasn't included in their data set. So that's the first part. The second part, which is closely related to that, is that unlike consultants and many of them, nothing wrong with it, but we don't have approved lists. We don't have buy lists. We don't have concentrated, um, approved managers that work for all of our clients. And the reason is back to, how you mentioned and how we describe our business and our clients. There is no one size fits all solution. So our clients are sophisticated. They all have different roles that hedge funds play in their portfolios. And so giving them the raw data, the information, and the tools to interrogate that data and analyze it and scale is something that's really unique for them as well. And then the third part are our benchmarks. And so, benchmarks in general, indices are certainly not unique, but the quality of them, getting back to the completeness of data, getting back to this is all that we do is identify hedge funds, analyze them, and then classify them into strategies. And so our indices have been independently proven, which we can talk through at a later point, but to be the most accurate representation of hedge fund performance across all strategies. So really giving them the confidence, whether it's evaluating or benchmarking a fund, that they have the complete information and a relevant benchmark that's meaningful, or even more importantly than that, which is often less talked about, is using these benchmarks as inputs into their asset allocation models. So for any multi-asset portfolio, pension plan, if you will, they're always trying to determine how much, if any, capital do we want to allocate to whatever strategy, hedge funds in general, hedge fund strategies in particular. And so having accurate measurements of the characteristics and performance metrics of those strategies is extremely important in making accurate allocations.
So the completeness of your data implies the incompleteness of the data that most of us get to see. So where does that incompleteness come from and how is it manifesting itself in the data?
At a fundamental level, hedge funds are not required. There's no regulatory obligation to provide their data to anyone other than the regulatory bodies themselves who don't share it. And so what that means is hedge funds are going to share that information with intermediaries or counterparts or investors where they believe it benefits them, or at least the benefits outweigh the costs. It's very simple. They're going to share their data if they think it benefits them. They're going to share their time if they think it benefits them. Otherwise, there's nothing compelling them to do so. And so what that means is number one, these databases kind of all across the board. Um, yes, they're collecting data from a certain number of funds, and there may be for emerging managers, they're going to have a lot of them. But what we've seen is over the past 10 years, not only has this existed, but it's gotten a lot worse, is that a lot of high quality managers, typically they're above $1 billion, they simply don't see that the benefits outweigh any, the risks, and so they simply don't provide their data to any database, period. And so what that means is that any benchmark that's created, any set of analysis that is done using those commercial databases is flawed from the get-go. And so, that's part of the reason I think I'll give you a little bit more beyond that. Some of the main problems, and it comes back to incentives again, is I talked about kind of, are you going to have upside, right? Is a manager going to be identified by an institutional investor because they're on a database? And the answer historically over time they've seen is just emphatically no. It just really doesn't ever happen. So that would be your upside. At the end of the day, all they want to do is raise new capital or at least maintain capital from the right set of investors. And then what are the downsides? The downsides are also pretty clear and have grown over the years. Number one, this data will be sold to anybody. So commercial databases, they will sell this data to hedge funds, to reporters, to service providers, to allocators, of course. But if you look under the hood and get a sense of who the vast majority of their clients are, it's not allocators. It is all the other categories. So what that means is your data can be used against you, whether it's for competitive intelligence, whether it's a reporter writing a negative story because they see that you're in a significant drawdown. Hedge funds don't like losing control of their narrative. That's for sure. And so that's part of what they've seen over the years is that these databases will just resell this data to others. And then the other thing that's important to note is that a number of them also have media arms themselves. So they may be kind of a separate component of the company, or there may be this Chinese wall in between. But that being said, they know that their data is probably going to be scrutinized by the very own media, and they're providing it directly to them. So again, these are a lot of the drawbacks about having your data essentially publicly available. And when the benefits really aren't there, and that's been proven over time, that's part of the reasons why these databases just end up that they have a very laudable goal. They want to create organization and transparency. The problem is the hedge funds just don't see the benefits.
Are we missing out on the best or are we missing out on the worst of the
So
hedge fund?
that's a really great question. So, if you were just randomly missing from a sample, you just kind of sampled randomly from all the funds, and those are the funds you're missing, then it actually wouldn't really matter all that much, especially if you're creating benchmarks, right? So the strategy, you may have a smaller number of constituents, but it would still, just like in any poll where you're trying to understand what the population, estimating what the population is, if you have just a random sample, that's a really good random sample, it'll probably do a pretty good job if the sample's large enough to estimate that population. Um, from your question, just to answer directly, that's just not the case. And we always kind of knew this, and our clients knew this, and I tell you about the reason that we started Pivotal Path. Was really about from anecdotes all over the place that if you are an investor, you're an institutional investor, you have a portfolio of, let's say, 20 to 25 hedge funds, how many of them are going to be in a database? And time again, the answer is not that many. And so what you do find is there are a lot of other funds. So I'll get to kind of two sides of the equation. One is missing key contributors, which we'll talk about. The other part is actually adding a lot of noise of things that just simply aren't hedge funds. So let's start with the key contributors. So there is a academic body called the Institute for Private Capital. It's out of the University of North Carolina. And they did a study. Actually, they just updated it a couple of months ago, where they looked at all commercial databases for hedge funds. They looked at had access to PivotalPath aggregate data as well, and they compared that to what they know from SEC filings. And their conclusions were pretty astounding. I mean, even for us that where we expected a lot of these conclusions, um, the numbers themselves were really interesting. So the first part is in terms of just kind of what's going on, right? So, and I'm actually going to quote from something because I don't want to misstate it. Funds in commercial databases results in a substantial overcounting of institutional quality funds, and perhaps more importantly, a biased view of historical hedge fund risk and returns. And so, this kind of went on to say the raw count of funds available in commercial databases can be misleading, as many listed entities do not meet the criteria of institutional quality hedge funds. They oftentimes are including funds of one, managed accounts, redundant share classes, feeder funds, and private asset drawdown vehicles. And so that's the noise. And I'll give you a couple of specific examples. They also found that in terms of the larger $1 billion plus funds, they're missing hundreds of funds that we have that trust us with their data. And to your point, these aren't just random. These are funds that actually have almost double the performance of all other funds that they cover. So I'll give you kind of a key stat to take away. Um, Funds that are exclusive to Pivotal Path, meaning they've trusted us with their information for years, um, they actually have over 4% more per annum in performance. And this was an evaluation period between 2013 and 2022. So a 10-year period. 400 basis points per annum is quite significant, especially with much of that being a zero interest rate environment. In addition to that, over 4%, actually almost 4.5% of that is in the form of alpha. And alpha is obviously that's what investors are searching for when they invest in hedge funds. I mean, not all of them. Some are looking for higher returns, but alpha is the key ingredient. And so, getting back to what I mentioned earlier with asset allocation models, um, alpha is they're extremely sensitive to small changes in alpha, and that can be the difference. 400 basis points can easily be the difference between a model arguing for a significant allocation to hedge funds in general or zero. And so that's why these things really do matter. But let me get back to the other side. So first, yes, you're missing key contributors. Overall performance is artificially lower, and there's a lot of repercussions down the road with investors that um, affect their outcomes significantly. But the other part of that is just the noise itself. So getting back to a lot of these databases, they can't really differentiate what is a hedge fund versus something else. That's really important. And we'll start at a very high level. And I'm going to use this because it's publicly out there. Um, Preqin states that there are 30,000 hedge funds globally. And we know this, and the Institute for Private Capital, as well as our clients and from JP Morgan and Grosvenor and others have done studies where we know that's about an order of magnitude too high, right? And so when you go from 30,000 back to roughly 3,000 hedge funds, um, it's hard to have confidence that if they're overstating just the simple number of opportunities that are out there by that much, it's hard to have faith that any sort of benchmark that you would create from a performance perspective would be meaningful in any way. And so, unfortunately, these databases, just through sheer numbers like that, and I'll go down to a specific manager, can't say the name, but I'll give you an example that when you have data that varies that much from database to database, then the truth becomes very difficult to agree upon. And that just means it becomes opinions. Well, this database says that, that database says this. We think, and these are not productive conversations, and they shouldn't be where both managers and investors are spending their time. There should be a foundational truth that everyone agrees with. So that's really important. And I'll give you a simple example. One of the largest hedge funds that exists. We know them quite well. We speak to them on a regular basis on behalf of our allocator clients. We know them to have three different offerings, and the databases, and it varies by them. range anywhere from 26 to 76 offerings. And so it's just not true. They know that. But how do these databases get there? Well, they don't have direct relationships with the managers. So they are typically working with public data that they can scrape. So what can they scrape from filings? And to check a box as an RIA that you are a hedge fund doesn't necessarily mean that you're a hedge fund. Certainly doesn't mean that any institutional investor would consider you a hedge fund. Many times you might not even be open for investment. So that's part of it. But when working backwards and not having any way to really confirm that, they just start with what the public data says. They also oftentimes are doing FOIA requests. And so when you do these Freedom of Information Act requests, you can get from, hey, a public pension fund has an investment that sounds similar to a large hedge fund that we know. And it could be as we mentioned earlier, could be a fund of one, could be something that is not offered to anybody else, could have many changes to that individual portfolio. There's all sorts of things that you just have no insight into. And so even if you have that performance data, it's not even accurate. And it could vary all over the place. So even when you have things that do have return streams, what is it that you actually have? Reconciling that back to an individual return stream is almost impossible. And we didn't do that analysis, but that's again what the Institute for Private Capital did. So I'll pause there a bit. We could obviously go down any of these rabbit holes, but just wanted to share kind of from a higher level down to real life examples, how this data gets misconstrued and then, what that means for the end investors.
Breakthroughs begin with semiconductors. With over 23 billion in assets under management, the VanEck Semiconductor ETF SMH is not only the largest semiconductor ETF, but it has also outperformed the next largest semiconductor ETF. It is built on an intelligently designed and constrained index that includes the whole sector stack, from design to manufacturing. Historically, this unique construction methodology have helped SMH outperform its closest ETF competitor. Check out the table below. Go to vaneck.com/SMHmax to learn more. Using a similar philosophy, the VanEck Fabless Semiconductor ETF, SMHX, goes even deeper, exclusively investing in fabless semiconductor innovators designing AI infrastructure behind the scenes. We're talking high bandwidth memory, power management chips, custom accelerators, and ultra-fast interconnects, the critical components that make large AI models run faster, smarter, and more efficiently. Go to vaneck.com/SMHXmax to learn more. And now back to the interview. Underreporting of performance would naturally lead to underinvestment. And I guess that maybe runs kind of afoul of the common narrative that we're like reaching peak pod or peak hedge fund. And so I would be interested to see, is it resulting in underinvestment? And how do you square that with these other narratives that, so much capital has flown into these massive hedge funds?
Look, the hedge fund industry, and then again, you'll read numbers that it could be 4.5, it hit 5.2 trillion. We don't know the exact number. We tag it closer to a little over 3 trillion, as we mentioned, because we know all the players in the space. And we covered not every single one of them, the vast majority. So um, typically, just that number in itself tells you one thing. And what does it tell you? It tells you that the industry is large. I mean, there's nothing, $3 trillion is certainly significant, but relative to how the private equity world has grown, relative to how, private credit has grown, it's still, I wouldn't say a drop in the bucket, but it's relatively small compared to other alternatives. And so that's number one. The second thing is there hasn't been a lot of new capital that has flown into the space for a number of years. For many years, that alternative capital is, wouldn't say it's a completely zero sum game, but oftentimes there are alternative buckets for multi asset portfolios, and it can be a comparison between private equity and hedge funds, or private credit and hedge funds. And for a number of years, private equity and private credit were certainly winning that battle. And so, what we saw in the industry, I mean, you're kind of alluding to the multi strats. The multi strats have grown much faster than the rest of the industry. And the industry has grown in single digits. And I think Goldman Sachs, I don't have the data in front of me, so I don't want to butcher it, but our data said something similar, where we looked at the period of growth in multi-strats between 2018 and 2024. And, it went from, I wouldn't say a cottage industry, but relatively small, under $100 billion to today where we're close to $400 billion, if not exceeding that. But it really did it at the expense of many of the other strategies. So you have one big pie, and capital within hedge funds definitely gravitated towards the larger multi-strats. They've gotten larger. And again, it's been at the expense of existing funds, but it's also been at the expense of new launches that would have gone out on their own. But actually, these single managers, it's not that they didn't exist, it's that they were swallowed by a lot of the bigger multi-strats and you didn't really see them. That's changing, and we can talk about some of those trends. But it's our view and that of our clients, and you can't put a number because it didn't happen. But um, in terms of the underinvestment, there are plenty of our clients that think that if they had used our data over the years and our indices, it could be 1.5 to 2 times as large, just because it would be so much easier to make your arguments to your boards, your investment committees, your clients. And if you're using benchmarks that have artificially low performance, as I mentioned, and they're showing 4.5, 5% per annum and no alpha to the S&P, no matter how good you might claim to be, well, we're much better at picking managers than an index. It's still, well, why bother, right? Why spend all of that time and resources and energy and lock up capital and lose transparency to, at the end of the day, maybe generate 1 or 2% of alpha relative to traditional asset classes, especially if private credit and private equity are continuing to do extremely well. And that's been what we've been up against in the hedge fund space for years. So hopefully that gives you a backdrop. Obviously, I can't say, would it really be twice as large, but certainly I can give you real life examples. And I'll share one right here where we had a client, very large, well known investor in the hedge fund space, pretty significant hedge fund book. Let's call it, well north of $2 billion. Been investors for a very long period of time. They went through a merger and had kind of a new asset allocation group. This was a little over a year and a half ago. And what did they do? They used some of the commercial databases indices, and they said, really shouldn't be in hedge funds. I don't see any reason for it. And even though your performance has been good, it's hard to know whether that was luck or skill. And so we are going to shut down your hedge fund book, period. And you're going to focus more on private credit. You're going to focus more on public equities, private equities. And that's just one example. And we've seen that happen numerous times where the asset allocation side of the business says makes no sense. Or, maybe you could put 5 or 10% in, but not the 20 to 30% that may make the most sense if you had accurate data plugging it into your model. So again, real life consequences of underestimating performance.
Would you go so far as to say you're also comparing against fake-ish marks on the private side?
Hard to say. I think it's an unfair comparison always. There's definitely a reason beyond just the simple returns in private equity why a lot of investors really like that space and private credit, as well. I mean, number one, if you don't mark your portfolio very often, then doesn't look like you have a lot of volatility. You also don't often see drawdowns because they're marked over, a longer period of time where you might have gone down and up. And so what happens is it's a pretty compelling return stream from traditional Sharpe ratios, your risk adjusted returns, the drawdowns that I mentioned. And again, if your correlation is arbitrarily extremely low just because you don't observe that private equities, if you had to sell your portfolio even today, and we're seeing, a lot of secondary action going on right now from some of the big, endowments, Yale most recently, it's going to be very different than where most of these portfolios are marked. So, yes, it's been an unfair comparison. But what I will say is, um, the liquidity is something that people appreciate liquidity when they don't have it, right? And that's happened numerous times. It happened during the global financial crisis. It's certainly a very good reminder of late, and that's one of the other reasons, besides that, not only hedge funds have performed extremely well over the last 5 years during a more difficult time for private equity and private credit to some degree, but they also do it in a much more transparent way and also a much more liquid way. And that liquidity is becoming a premium again. And so, while you asked about kind of, flows to some extent into the hedge fund space, there's a lot of pent up demand. In fact, we would say, and then we just had JP Morgan's CIO of alts on a recent webinar. And he said that this is probably the best, most exciting hedge fund environment from an investor perspective, possibly ever, certainly in over a decade. And we see exactly the same thing. What we haven't quite seen yet is the new capital to match the excitement and enthusiasm. And part of that has a lot to do with private equity still to this day hasn't really had the distributions that most of these investors rely on to rebalance their portfolios. The longer these distributions take, actually, the more it will likely benefit the hedge fund industry because just again, valuing liquidity is something that it's going to be at a premium again.
I was just talking to a manager who was lamenting a conversation he had with another one of his buddies who just got redeemed by an endowment, and the reason they redeemed was because they weren't getting distribution. So the liquidity actually resulted in him losing capital, not gaining it, despite people recognizing it as a benefit.
I mean, this has happened time and again. I come from the managed futures world, the CTA space, and that's where I was working from '06 to 2012. And during 2008, that was one of those years where CTAs, just like 2022, where they had this tremendous performance across the board and they were used as ATMs, right? Why? Because they were liquid. And instead of saying, this is fantastic, this is exactly why we have you, a lot of them lost significant capital in the process. In the end, those things tend to work in your favor, maybe temporarily. You will provide that liquidity. I'm not saying every investor remembers, but there's certainly goodwill that comes with that. So it's not all pure downside.
We've been talking about the data, but I think it would be helpful to get into what is the data that you are receiving and that your clients are interested in. If you've ever seen, a smattering of tear sheets, they really differ a lot, oftentimes between strategy, between fund, in terms of what data they are reporting. Some people just report monthly returns. Others are getting very deep into the attribution of what happened in the month. When you talk about the data, what is it?
That's a really good question because the data can be, to your point, it can be a lot of different things. And just as you mentioned, we see thousands and thousands of monthly fact sheets, and there's very little standardization at all. Right. So that's actually part of what we do on behalf of really the funds as well is we provide that standardization so allocators can actually make apples to apples comparisons very quickly. But what does that mean, right? So if you think about, what is the data? Yes, performance is extremely important, and having that complete. It's not just completeness in the coverage; it's also completeness in the track record, right? You can't have holes in a track record, so that's really important as well. But beyond that, just to kind of take a step back, just and share how our clients are working with us. There's really two key questions that we help them answer. And this really defines due diligence in general. But the first question is, does a manager do what they say they do? Right. Second question is, do they do it better than my other options as an investor? So in the first question, if you only have returns, you don't know what they say. Right. And so it's very hard to know what that means. But if a manager tells you, this is my edge, right? This is why you should invest in me. Here's what I can add to your portfolio. Here's what we do that's better than our peer group or differentiated. Um, those are things that are extremely important to investors and oftentimes very much lost on the managers, which we can come back to in a little bit. But that's the first question. So, in order to answer, well, do you do what they say they do? You have to know what they say. And that means you have to meet with them. You have to speak with them. You have to have marketing materials and well beyond just, here's our performance. So, as on behalf of all of our investor clients, we are treated just as any consultant would be, any investor would be. We're on distribution lists. We have access to data rooms. But most importantly, we have direct relationships with every hedge fund that we cover, and we speak to them on a regular basis. So we have essentially transcripts of our conversations that our clients, from a factual perspective, we actually remove opinion. We don't want to have our opinion to bias our investors at this point. We want them to be able to look at the facts as given to them by the managers and saying, this is what we do. The performance is what they actually do, right? So to the extent those things are consistent, that's a really good thing. To the extent that those things are very inconsistent, that can kill any potential opportunity from the start, right? So that's the first thing. The second part of it is once you go beyond, all right, we can do this for a single fund, and every hedge fund investor, no matter how large or small their organization is, you certainly can conduct due diligence on a fund or a set of funds or a group of funds. What becomes hard and difficult, and the problems we solve, is doing this in scale, right? And there may not be 30,000 hedge funds, but 3,000 is still a pretty large number, right? And when you're looking at a certain strategy, there could be 100 plus high quality hedge funds that might make a lot of sense for you to, at a minimum, be aware of. And it's that context of being able to quickly evaluate, is their edge their edge? Are they consistently, maybe not a top decile, top quartile, but are they consistently affecting the strategy thesis that was laid out? And are they doing it in a way that's not only consistent, but better or just as good as all of their peers in the distribution I have access to? That can be, really powerful for me as an investor to, number one, just figure out where do I want to spend my time without feeling like if I concentrate on these groups of funds, gosh, what if I missed, a number of other funds that I just never heard of, or I've heard of their name, but I didn't have the time to really conduct a deep dive because we can't do a deep dive on every fund. So those are some of the things that we talk about, that we provide our clients that certainly, I mean, commercial databases don't have any of that. And that's number one. And the second part is, again, relative to other consultants, we're not just doing this on an approved list or a small concentrated list. We're doing this on every single fund that's out there.
What's a good example of a narrative performance violation or a common example that you see?
The most common example is that if you talk to a fund and you ask them, what's your strategy? Who are your peers? What do you think your edge is? So many times, these managers or people from the IR group, and this isn't to be nefarious or at all, but they will so often say that, well, we don't have a peer group. What we do is so unique that you just need to look at us and just you make your decision based on what we do. And um, when you analyze the data, when you talk to a lot of managers, you start to realize very quickly, look, there's only so many things you can do. It's not that you don't have uniqueness, but to say that there's no one doing anything like what you do, I mean, we've talked to managers where they correlate to our index at 0.85 or zero point 0.9. I mean, just like the most basic analysis that you can do and say, yeah, this is your peer group. What you're doing is very similar to what a lot of them are doing. So that's number one. You have to realize that there are plenty of other options out there. And the second thing is, which is really interesting because especially on the equity side, you think about managers who are making investments in single stocks, right, both long and short. Would they ever invest in a company if management not only, didn't know what their competitive advantage was and what their competitors were doing, but also didn't care? The answer is probably not, right? So to think that hedge fund in your own company, which is hedge fund's a company that you're selling as a product to investors, that you don't need to know what your competition looks like, you're missing out. And so that's flaw number one. The second thing that we see so often is that a manager will say, well, it doesn't really matter how I frame the story because the investor is going to do their own due diligence. They're going to come to their own conclusions, and I can't sway them one way or the other. All I can need to do is focus on the data, do my best, and if the data works, then it'll work. And again, simply not the case. There are plenty of funds that have great performance that really never get off the ground. There are plenty of funds with mediocre performance that are amazing communicators that raise significant assets. So just on the face, that's not the case. But then you think about how does the investment process work for really any investor, but certainly institutional investors, where that person you're talking to on the other side of the table, they're not making a decision in a vacuum either, right? So they have colleagues, bosses, boards, investment committees, clients, right? All these different constituents. And so to the extent you can help them, this is what we do. This is our edge. And in a couple of bullet points, you can give them something that is very clear, it's understandable, and it's something that they can actually convey, and it's supported by data. They can now convey it to whoever else they need to convince. That's extremely powerful. And so hedge funds, like anything else, they're sold much more than they are just bought, right? And so in order to sell something, you need to communicate what you do, obviously, but you need to communicate it in context and be able to have that conversation of why it's valuable and why it's unique and be confident yourself that what you're saying is true. Because again, the second you say this is my edge and the data tells you something else, that conversation is probably over forever. And you lose instant credibility. So those are some of the mistakes, the first 2 that come to mind. There's plenty of others, and I'm happy to give you more, but, hopefully that just sheds a little bit of light on it.
What about some of the things that people are doing better now than ever in terms of communication, in terms of understanding, their returns? How much has the industry improved in this way since you got started?
The industry has improved a lot, for at a number of different levels. The first level is, just transparency itself from the funds. And this is something that, they're not transparent to everybody, right? So again, the databases, no. A random investor, probably not. But to institutional investors, they've become much more transparent. And part of it's because if you just look at kind of the overall, what's the pie of hedge fund investors, right? Pre-financial crisis, the majority of hedge fund capital came from fund of funds. And not to say that all fund of funds weren't doing deep due diligence, but at least in general, it's very different than once you get over to the pension side and the endowment side. And so the investor base today, fund of funds make up less than 10%. It has been filled by those institutional professional investors. And so just the demand for transparency has grown as investors have become more sophisticated themselves, and they've evolved into kind of a more um, institutional group. The second part is that I think hedge funds have also realized that, well, being transparent, there's not a whole lot of downside if I'm transparent with the right people. Right. If I'm, just say to an institutional investor, well, we don't provide this level of daily returns or whatever it may be, you're probably going to lose, you're going to lose out. And so we've definitely seen a trend towards becoming more transparent. That's number one. The second part is, and this is a much more recent trend, and that it goes even further from a transparency side, just in the due diligence process, is hedge funds have also realized that, offering separate accounts or being willing to, uh, trade in a separate account, is something that, it used to just be restricted to the largest investors writing very large checks to the most liquid strategies like CTAs and managed futures are one of the earliest strategies that, um, very much were offering separately managed accounts back in, even in, early 2000s. Um, Today, and this is a due diligence question that we ask, but every hedge fund investor, at a minimum, just wants to know: are you willing to offer a separately managed account, even if they invest in the commingled fund? Just the answer to that question is telling. And so we see that managers, large and small, across many different strategies, have not only become more willing and are offering separately managed accounts, and we've seen a whole new ecosystem of managed account platforms that help facilitate that. So again, you don't have to be this large investor on one side that is able to do this on your own because you have significant resources. It's become more democratized, but it also just shows that hedge funds, they've started to become much more solution providers, right? So getting away from, here's my commingled vehicle. You as an investor can either make a decision to invest or to not invest. Now it's much more they're sitting down with the investors. They're having conversations about what are the needs of the investors, what are they looking for. The commingled vehicle, if that isn't a fit, there's a lot of things that we can do as a manager. And within reason, but we can create customization that that really solve problems. And so the whole dynamic of how investors and hedge funds, GPs and LPs are communicating with each other is evolving in a very healthy way, we think, but definitely has improved. So I think, start with that premise, and that's going to lead to much stronger and longer lasting relationships because it's no longer, I just have one binary choice. If I want to solve another problem, I now have a history with this manager of them doing just that. And I'm going to sit down and talk to them about it.
Is there any concern about internal alpha capture at some of these more sophisticated LPs that have pretty advanced internal trading, that they might be some of the alpha is being taken from the SMAs?
There's always going to be that concern. And I think the answer to your question is probably a little bit of that. I'm sure there's been, so it's like anything, it's going to come down to trust. And there are certain organizations that haven't operated to garner that trust. So maybe, managers won't set up separately managed accounts with them. But in general, um, most, I don't know if I can say most, but there are plenty of very sophisticated, trustworthy investors that it's going to benefit both sides because there's a sharing of information. It's not just we want to see everything you do, and we've got this thing over here where we can also do something else. If they are, making, there's still a lot of co-investments, and even in more liquid trades where, again, this is all discussed, above, on the table. So I think it just comes down to trust and being able to communicate and not just being a sterile transaction, but building relationships. And that's something that definitely has evolved over the years.
Let's zoom in a little bit on 2025, what's happening right now. Where are allocators looking at this moment in time?
So maybe I can just give kind of a quick high level, highlight some performance. We'll start there and then we can give a little bit more and then where the interest lies. So year to date, this is through May, and then we're going to see some better numbers come out in June as well. But our composite, which covers again 40 strategies, all the different managers that we have, meet a certain level of criteria, but it's returned over 2%. And you can say, oh well, first 5 months, 2%. Maybe that's not that big of a deal, but if you dive in a little bit further, even at the composite level, you see that it hasn't been down at all throughout the year, right? And we know that from February to April, the S&P had a drawdown of 19%. I mean, so there's been a lot of volatility and significant uncertainty around just markets in general. So it's been a much, much smoother ride for any diversified hedge fund investor, number one. To give you a little bit of context, the annualized volatility of our composite, which again, it's not necessarily an apples to apples comparison, but it is a point of reference, about 3%. The S&P annualizes at about 16.5% historically. So you're talking about on apples to apples basis, the S&P over the last year has been over 12. And even that's because a lot of the volatility has been intra-month. I'm just looking monthly snapshots. And so it's 4 times the volatility. But then if you think about the VIX, kind of a forward-looking volatility estimate, we've seen that spike, upwards of 50, some, even saw 60 for a very short period of time. But it remained elevated over 35 for a while. So you're talking about kind of periods where, 10, 20x the volatility that you're seeing kind of in a diversified hedge fund portfolio. So that's just important to note. Um, in addition to that, 66% of the funds that we cover have been positive year to date. So there's dispersion across strategies for sure, and we'll get into that. But 66%, so 2/3 of managers are positive. They've annualized or they've up about 6.2% through May. Again, that number is going to improve in June. And then the other third has been down, and they've been down about 7%. So just to kind of give you what that dispersion looks like year to date. And then let's focus on some of the highlights. So, um, equity quant. Equity quant is a strategy that is up 7.4% through May. This is a strategy that was almost left for dead coming into 2020. It went through a 5-year period where, at best, it was flat to up very small to to being down a little bit. And this is during a period of time where the S&P was doing extremely well. And so, there was a lot of questions of whether quant systematic managers um, have a role in your portfolio anymore. Interestingly, 2020 began. And so when we see that equity quant is the leader year to date across all the strategies that we cover, at least all at a high, all the high level strategies we cover, um, that's also been the case over a 3-year period where it's annualized over 11%. That's also the case over a 5-year period where it's annualized close to 10.5%. And then if you look at the quality of that performance, it's actually been not all, but a vast majority of their performance has been in the form of alpha. So highly coveted types of performance. And again, this isn't a 1 month or even 6 month or year to date phenomenon. This is something that has been consistently happening. And we've been talking about it with our clients since 2020. So again, we could talk a little bit about some of the reasons why, but that's something that our clients certainly have been following very closely. They've been making investments in that space. That is no longer a space that is just, well, it's a black box and we don't really understand it. As AI has become more accepted and performance has been extremely good, and there's a lot of reasons why behind that, but there's been a lot more comfort in, we can't just ignore these strategies because we don't understand them. We need to understand them. And we need to understand there are investment theses behind this, even if there are AI or machine learning models that are helping find these patterns, there are theses behind this. So, you know, those types of managers have done really well. Credit managers have also done quite well. So credit has been generating, 6, 7% per annum. And when you look at the last couple of years, it's even been higher than that. Um, when you compare it to private credit, and it's a little bit difficult to even know, well, what do we mean by private credit? What are the returns? But the expectations of kind of generally in private credit has been kind of high single digits to low double digits. And the hedge funds have been putting up those numbers or better, and they've been doing it with liquidity, right? So again, getting back to that liquidity, do I really want to trade off locking up my capital when I can actually see the returns and understand them and get access to my money if I need it? So a lot of interest in credit, and that's not new either. Multi-strats certainly continue to perform well. They're only up about 2% year to date, and that's through May as well. But again, these they've been performing and managing their their downside extremely well since 2020, really much longer than that. But they've been tested time and time again, and their risk management has improved tremendously. There will always be interest in the multi strats unless some event happens where they, really do have a huge unwind and kind of all the worst fears are realized. It just hasn't happened. And these have been, people have been calling for this, really since the financial crisis, as the industry went from, first it was a manager could never get beyond 10 billion, then they'd have too much capital. And then it was 20, and then it was 30. And now we see at 70, billion plus, some of these managers are still the best in the space. So um, that definitely remains of interest. On the flip side, and hard for me to speak about this because of my close ties to managed futures, but managed futures have had an extremely tough time. Year to date, they're the worst performing strategy. They're down over 10% through May. I think they're probably going to have a little bit of a reprieve in June. But if you look back over a year, they are also the worst performer, down about 15%. So a significant drawdown, and historically a very significant one for them as well, after having such a strong period in 2022. So a little bit sad to see that, but I'll highlight one more important point. And this also is around where the interest lies. It's also in the global macro space, and global macro quant, interestingly enough, has always been, we always call it kind of the first cousin of CTAs or managed futures. But what's really interesting is global macro quant has, it's actually flat year to date through May. So it's a difference of 10% between them and managed futures, which historically is the largest difference that we've seen. So that's number one, which probably worth a conversation on its own. But we also see that global macro discretionary managers, which also tend to have reasonable correlation to more of the longer term trend followers trading similar vehicles and markets, they're up over 7.5% through May. And so this was something that a lot of our clients were really interested in the macro discretionary space for exactly this reason, that sometimes trends reverse. And there was a lot of uncertainty, heading into the end of last year. And trend models don't care about uncertainty, they care about price action. And so many of these long-term trends in rates and the dollar, they were so entrenched that it takes a very long time really for these models to reverse. And so when you have sudden reversals and spikes in volatility and all of these things, managed futures can get whipsawed in those types of transitional periods. And fortunately, the on the global macro discretionary side, they've been able to navigate these sudden changes much faster because in some ways, while they may have been sudden in the markets, they were expected from a lot of the more traditional economists in terms of what would happen to the dollar and what would happen to rates, under a new administration and what might tariffs. I mean, all of these things have been discussed ad nauseum, certainly since the end of last year. So a lot of really good bright spots in the hedge fund industry. And our clients are interested in certainly all of those strategies. And we could go into, kind of across the board geographically and then, sub strategies within. But let me just pause there and hopefully that, good conversation starter on those.
Yeah, I guess obviously the multi-strats kind of match the composite. Historically, they've been mostly equity shops, but that has been changing over time. Are they evolving to be kind of like the composite of all of the strategies in the industry?
That's another great question. I don't think so. And I'll tell you why. So um, there are a couple of things to note and that actually support what you just said at a high level. And I'll actually start there because I think it is worth noting. And it's something that we didn't expect. And even when you say it to the most sophisticated investors, it's kind of a bit of a shock. Just looking at a simple statistic of multi-strats relative to the S&P over the last year, just correlation. Um, eh, and I've asked people kind of, what do you think? I'm not going to put you on the spot, but the correlation is 0.75 over the last 12 months. And most people, and to some extent, rightfully so, are often thinking of multi-strats, maybe not all of them, but many of them as market neutral, right? They're really able that they are hedging out all the different factor exposures that you can imagine. And so they correlate to nothing. And we always say correlate to nothing but each other. But in this case, what you see is the correlation to the S&P has gone up significantly. It's at one of the highest levels we've ever seen. Um, that being said, because they take so much less risk, at least on kind of a volatility standpoint, we could talk about whether there's risk embedded in the leverage, but from kind of looking at the smoothness of the ride, it's still relatively low. I mean, you're talking about like zero point 0.2. So if the S&P dropped 10% and they fell 2%, would it feel like they were that highly correlated? It might not feel that way, even if that's the case. So definitely something to watch and keep an eye on. Is this correlation going to stick around? Um, our view is more that these things happen typically around spikes in volatility where asset class correlations go up. And so because of that, it's very hard to hedge out all your correlations to everything in those types of periods. What you really should be doing, and I think they've done a great job at, is managing your downside and making sure that you're not being carried out in huge unwinds and crowded trades and things like that. So um, that's kind of the starting point of it. But I think multi-strats in general are much more than just kind of a diverse set of strategies. If you think about the models that have worked really well, these are organizations that are incredibly good at hiring, building businesses, incentivizing people, and then over all of that, managing risk within and understanding of all the different choices that they have, whether it's systematic or discretionary or combination of both, being able to kind of press the right levers at the right time, depending on the environment. And I mean, if the last 5 years that feel like the 25 years don't tell you that they've been able to navigate, from COVID to 2022, where everything was hurt, they are fantastic risk managers. And you're right that, it's no longer that most of them, part of it's to maybe expand capacity, but also they're not just equity managers. They're not just, sector traders in a market neutral way. They've gone into fixed income. They've gone into global macro, heavily into commodities in some cases. And so they're giving themselves more options, more optionality to find the right opportunities. But I think that these kind of anyone who thinks that they can do it themselves, and we've seen fund of funds historically that in some ways are very similar, and maybe you could even argue that they're converging once again because the multi-strats are now investing externally. We could talk about that in kind of trends that we're seeing and what's going to happen in the future. But um, I don't think that they've become commoditized by any means, and I think there's a tremendous amount of value that they've proven that they will continue to add.
I wanna get into those future trends, but one final question, on dispersion. I love to talk about size dispersion. How are the little guys doing compared to the big guys?
Yeah, so this is an interesting year, and part of it is probably because we just don't have that much data. Right at the end of the year, things start to kind of normalize a bit, but we see this very weird. If I were to show you a graph of it, it would look very strange to you, where you see funds $5 billion and above. It's actually the only cohort that we have that's down year to date. It's down 2.7%. Every other cohort, and we break it out by less than 100 million, 150 to 250, and a couple of different other ranges. They're all positive. And for the most part, it's kind of the middle of that road where they are the best performers. And so I don't know that there's a ton you can tell other than managed futures is driving a lot of that, greater than $5 billion, just because it's driving the average down significantly. So that may be the story in itself. And sometimes we can see because there's some large number of large managers that are going to be very similar in terms of when they're struggling with performance. So that's part of it. The other part of it is, the funds that are less than $100 million, when volatility spikes, those strategies tend to, not always, but tend to have in general more a higher beta or higher exposure to equity markets, U.S. equity markets in particular. So when equity markets are doing really well, they'll typically look really good. When equity markets are struggling and there's a lot of volatility back and forth, those strategies will be towards the bottom. So that's also happening this year. But I think, again, this is only 5 months into it. And if it's going to depend where obviously the markets shape up, but I wouldn't read too much into the size component in terms of dispersion and performance quite yet.
Do you think the little guys are kind of masquerading as hedge fund managers in many cases, doing things that are they're predominantly long biased, long only types of things? They might do some trading on the side that looks like what is the majority of what the larger funds are doing. I mean, do you notice any difference in the strategy and institutional quality by size?
A lot of the smaller managers are going to be equity managers, and just because you are long biased doesn't mean that you aren't a hedge fund, right? Meaning that you have a hedge fund vehicle, you charge hedge fund like fees. There are lots of long bias strategies. As long as you are, again, communicating, that's what you do in the right way. It doesn't mean that you couldn't be of significant interest, and people may think of you as part of an extension of their equity bucket as opposed to a hedge fund or a pure hedge. But as long as you do what you say you do, that's fine. And there are plenty of strategies, like for example, the equity sector focused strategies that we cover. Healthcare and TMT, so technology, media, and telecom, financials. Right. Most of those managers, there are some, especially in healthcare and TMT, healthcare in particular, pretty difficult to run, a low net or low beta or a market neutral portfolio. There are some that do it, but there's a lot of reasons why you don't want to short a lot of these companies. It's hard to short companies. There's all sorts of things, especially in biotech and where, companies are being bought out where you just have so little information to guard against that, it's very difficult to short stocks with conviction. We see similar things globally in China and Hong Kong, where shorting is much more difficult. So depending on what your sector is or your geography, sometimes you may not really have that luxury, or it's just not a smart thing to do. Um, that being said, I mean, let's take TMT that I mentioned. One of the very short, quick analysis that we did earlier this week was just looking at how the correlation between um, the TMT index, our index, is about 0.93 over the last 18 months to Goldman Sachs VIP long list, right? And it's about 0.92 to the Nasdaq. So it's it's high correlation, and this is the highest it's ever been. And That doesn't mean that they don't have hedges in place. They're running with less volatility. There's less exposure, but clearly you can see that they're going to be at the whim of the Nasdaq, or at, in this case, Goldman Sachs VIP longs, or artificial intelligence. Magnificent Seven has come down actually substantially since highs that we saw, a year or two ago. So, it's really about understanding what the strategy is doing. And if you're in a strategy and you're a huge outlier and everyone else is more hedged and that's how you communicate yourselves, that's not a good thing. But as a small manager, yeah, you can take advantage of anything that you want, but there's a lot of them that are going to be more in that long bias space, in the equity space. And so that's, they're also not going to have the layers of risk management that necessarily that a lot of the other more tried and true managers have. So there's a number of things there, but and I hate to purely generalize things, but those are some trends that we just see time and time again, and those are some of the reasons why.
What are the big trends that you're seeing right now looking out to the second half of 2025 and beyond?
One of the big trends, which isn't really talked about so much, I mean, we've seen it in fits and starts, but it's consolidation in the industry. And so M&A, we're talking about, funds that are buying funds, funds that are merging with funds. And this is not just limited to a couple of funds that we've read about. There's a lot going on behind the scenes where there are people looking for alpha, right? And it's seeing that the talent pool is, maybe there is a limit on it. So you might want to look within as opposed to continuing to try and hire new. And we're also seeing, I think the more important trend is, yeah, I talked earlier about hedge funds and private equity, and kind of maybe being in the same boat, 15 years ago. Private equity is done like this, and hedge funds in terms of growth has done like that. And part of that is private equity has definitely figured out how to live beyond its founders, right? Second generation management, third generation management. We've seen at the highest level from, Blackstones and BlackRocks of the world, but it's no longer that it's a single person behind these big private equity firms. And hedge funds, up until a few years ago, even have been more of a mom and pop industry where once the founder or the portfolio manager retires, the business typically doesn't last, or is just shut down immediately. And so we're seeing, the industry is starting to institutionalize. The investor base is institutionalized. We talked about, how managers are solving problems and really sitting on the same side of the table. And they also want to make sure that they're staying power. And so you're seeing changes in management. You're seeing generational planning. You're seeing a whole new cottage industry of some really smart kind of investment banking and advisory businesses that are cropping up to help facilitate this. And in general, we think it's going to be a real positive for the industry to really build up, again, firms, and not just like hedge funds, but hedge fund managers that have these firms that can, really survive change in leadership and continue on and build significant businesses and wealth for their investors. So that's a big trend. We think that's only going to grow going forward, and so that's something that we're definitely watching with our clients as well.
I want to close actually with one line of questioning, which is about how to get on to platforms like yourself. What makes a fund an institutional quality fund worthy of being included? Because everybody wants to get this exposure to the types of clients that you have.
So our objective as a firm is to have every single institutionally relevant manager on the platform, period. Right. So how do we do that? Um, we do it, unfortunately, in a lot of different ways where obviously, we all have our own networks. That's fine. But we have our own client base and we're constantly talking to our clients. So if a client comes to us, it could be a $20 million fund. If a client says, hey, this is a fund that we want you to look at, we will onboard that fund, and we will have that information available to them, because we know if it's of interest to one client, may not be of interest to all clients, but it certainly will be interest to more than that, just that one. So that's number one. Anything that comes specifically from a client, we're going to add that fund. Um, the other thing that's really important in this industry is you have to have relationships with all of the prime brokers, right? Because if you are a fund of any kind, you have to have a prime broker or multiple prime brokers, whether it's tier one, tier two. tier three. And so those prime brokers have their hand on the pulse of all the managers that are out there. And we are constantly talking, from the Goldmans and JP Morgans and Morgan Stanleys on down the list, constantly talking to them, attending their conferences, asking them who they're doing business with, or they're coming to us and saying, "Hey, we would like your clients to meet, this fund." Um, they are so integral to the flow of information, and this is something that it's constantly evolving. So you never have, well, here's the set of funds, and now we're good to go. And this is a dynamic thing. It's something that every single month we're always adding funds. Funds are obviously shutting down as well. Um, but that's our goal. And so there isn't a number. It's not, well, if you're above $25 million, you're on the platform. It's really, would an institutional investor believe that you have the infrastructure and capability of putting their capital to work? And if the answer is yes, which is a pretty low bar, um, we will then make sure that we have that fund. Now, to be part of our indices, there has to be additional criteria in terms of size and length of track record. But to be part of our platform and part of a peer group, um, that's how we are constantly thinking about it. So that's the starting point.
We all kind of imagine it's like, all right, if I just put up the big number this year, I'll be at the top of the list when people go to sort by who did the best last year. And obviously, that's not how people are discovering funds. And obviously, people do that, sort of out of curiosity, but it's not necessarily going to result in the type of conversations that, produce asset growth.
Yeah, and to that point exactly. Not all performance is created equal, for sure, right? So a 20% is not the same as another 20%. So it depends on the quality of the performance. And that's really knowing how to analyze that performance within a peer group, within context. I mean, all sorts of things that we could get into, but it's also, allocators have become very deliberate in what they're looking for. So it's about giving your clients the ability, have to have the data first, but then the ability to conduct efficient searches, right? So clients may be looking for, funds within credit that are above a certain AUM, that are located in a certain place, where they offer separately managed accounts with minimums below, and you can go on and on and on. And so the idea is, how can you answer those questions quickly? And that's through technology, potentially through some AI as well. But it's starting with, do you have the information? Can you structure that information so your clients can efficiently search it and interrogate it? And that's how you help them answer questions efficiently and in scale. And so I'll give you kind of a couple of simple reasons, that our clients work with us. I mean, the first part is, obviously, yes, are they sourcing managers, they evaluating them, monitoring them going forward. But sometimes it's even more simple than that. And it comes back to their client or their board or somebody else. What do you think of this fund? Right? And just that basic question, if they don't cover them, that can be a really difficult question to answer, because it's probably not on the databases, or at least, it's large probability that they're not. And so what do you do? That's going to be a lot of time to reach out to your network, find an introduction to that manager, reach out to the manager, probably set expectations that are unreasonable, where the manager now thinks there's a good probability that they could land you as a client. And all you wanted to do was answer a simple question for a client about, like, here's what the manager does. Here's where their performance, is consistent with what they say it is. And here's some basic information. I mean, I can't tell you how many of our clients use us as that intermediary, so they don't waste their time or the manager's time. So you just talk about efficiency. But at the end of the day, you have to have the right set of funds, and you really have to give them confidence in their decision making. And again, it comes back to, how can you be confident that you've made a good decision if you don't even know what all the choices are? Right? That's a difficult thing that hangs over investors' heads. And so when they know the completeness of our coverage, and they know that they didn't overlook something, and they know that they didn't have to spend hours and hours on every single fund to rule them out, because they could do it objectively through the data and the information and the tools, um, that's going to give you a lot more confidence around your decisions. Going to give your clients and boards and investment committees a lot more confidence. And at the end of the day, that's what we're helping our clients do: make decisions that are complete, comprehensive, done with confidence. And that's very different than certainly any other database, and any relationship with a consultant as well.
All right, John. Well, I think we'll leave it right there. Where can people find more information from Pivotal Path, more from you?
So our website, pivotalpath.com, that'll tell you who we are and what we do. It also has our research there. So you'll see we put out a monthly pivotal point of view, and a lot of the things that I mentioned here and trends and performance, freely available. You can just sign up for it. There's no paywall or anything like that. You can also follow us on LinkedIn at Pivotal Path, and we post a lot of our research there as well.
All right, John, thank you so much for coming to talk to us about this marketplace, products and services.
Great. Max, thank you so much for having me. Really enjoyed the conversation.
Thanks for tuning in. Looking into SMH or SMHX? Head to vaneck.com/SMH Max and vaneck.com/SMHX Max to learn more.